Hello everybody, thanks for joining. This is going to be a quick video on life insurance. This is going to answer most questions that you have, and if it doesn't, please let me know. Leave a comment and I will respond or make another video if need be. For the most part, there are two different types of insurance: temporary insurance and permanent insurance. So if you know anything about insurance, or if you see the commercials or the advertisements, you'll see term, whole, universal, final expense, guaranteed issue, simplified issue. By the time this video is over, you should have a basic knowledge on these different types of insurance. Is it temporary? Is it permanent? What's good? What's bad? And what will be best for you? My number one question, and probably every agent's number one question, is which one is better? And like we tell our members in Medicare, we can't necessarily say which one is better, because what's better for me may not be better for you. So I said all that to say it depends on you. It depends on your needs. Is anyone financially dependent on you? Do you have high expenses? Are you on a budget? All of these things matter. For example, if I'm looking for something that's more long-term, a safer bet, I will probably invest in permanent insurance. However, if my expenses are relatively high and I need to make sure that it's covered, I will probably go for temporary insurance or a mixture of the two. Okay, so let's discuss term. I put term first because term is the type of insurance that you usually see the most. Term is very attractive because it has large policy amounts and the premiums are usually low. Okay, terms come in usually about 5, 10, 20, 25, 30 years. I've seen 35 years before, but pretty much that's the term. It's temporary insurance. So I kind of explain it like it's a rental policy. So you have life insurance, but it's only rented. So after your term is over, you have to renew that policy. Okay. They usually have affordable premiums because it's really a gamble. Okay, so the game of insurance is all about a gamble. It's about beating the odds. Either you win or the insurance company wins. And that's really the bottom line when it comes to insurance. So terms are a big gamble. But for the most part, I like them because they offer consistency and they offer peace of mind. Okay, and it doesn't have to cost as much, so you can afford it because the premiums are affordable. Okay, they don't have a surrender value because they don't have value. Okay, this money is temporary. You cannot have a value on something that's temporary because it doesn't technically belong to you, because remember, we are renting this policy. Because at the end of our 30 years or at the end of our 25 years, we may or may not choose to keep this policy. Okay, so that kind of brings me to my next point. When you have term insurance, at the end of your term, it is important to find out, one, you need to find out if it's an increasing term or a decreasing term. I know that probably doesn't make sense, but there are some insurances that start out really, really big, but as time goes on, they decrease. That's usually, sometimes people use it for things like mortgage, because whereas you may need $200,000 at year 1, at year 30, you may not need $200,000 because your mortgage is probably paid off at that point. So that's called a decreasing term. And then there's also the issue of insurability. So you want to know that at the end of your term, you will be able to be insured. Let me make it make sense to you. Let's say I'm 20. I get a 30-year policy. At the end of my 30 years, I'm now 50. Okay, so I'm not insured when I go into year 51 unless I renew my insurance. But what I need to find out is, are you going to automatically accept me if I continue to pay at my new rate, of course, or will you make me take a health test? Because in 30 years, anything can happen. I can be diagnosed with anything that will cause my premiums to go up, or that will cause me to not be insured at all. So if you do choose a term, it's important to remember, make sure that you have guaranteed insurability at the end of your term. Okay, so while you're in, and then think about it, while your insurability may be guaranteed, it does not mean that your premiums will not increase dramatically. Okay, because remember, at 20 we have one price, but at 50 now we're looking at an entirely different premium. Okay. Also, I know sometimes you hear people talking about borrowing from their insurance. You do not borrow from term insurance because it's temporary. Same thing as the surrender value. You don't, it's temporary. Okay. Mortgage protection. Now, a lot of people use term insurance for mortgage protection. And basically, that's just what mortgage protection is. It's a term insurance. Most mortgages are about 30 years. Terms are coincidentally 30 years. So if you do have a home, it's important that you insure it. And a term policy is a great way to insure your home. If you have a $300,000 home, I think it would be a great idea for you to get at least a $300,000 policy, because you have to make sure that your home is covered in the unfortunate event that you may pass away. You don't want to work for so many years to keep a home, and then you die, and then your home is taken away because your family can't keep it up. So if you do look into mortgage protection, make sure that you have something like a term policy. Okay, let's address whole life. So whole life is the permanent insurance. It's the total opposite of term insurance. This policy lasts until age 100. Does that mean you don't have it anymore at 100? No. It means at 100, your policy is completely paid off. You can take your money and you can go do whatever you want with it. Okay, so that's what whole life policy, that's what they consider a whole life, 100. They usually have higher premiums, relatively higher premiums, because the money is guaranteed. Whole life can actually be considered an asset. I don't know if you ever pay attention, or if you ever apply for any kind of assistance, they will ask you, do you have life insurance? And that's actually the life insurance that they are talking about. They're talking about whole life, because whole life has value. You can take money from whole life. Some people get a lot of money from whole life. That's why most of those companies ask you about life insurance. Okay. Whole life is sometimes smaller amounts. You won't necessarily see someone walking around with $100 million. Well, they won't have that much anyway. You won't see someone walking around with a 500,000 whole life, but you will see a bunch of people walking around with a 500,000 term life. Not saying that they don't have that, but I'm just saying it's not as common as seeing those with the terms. So you'll see smaller amounts because these amounts are for certain. These amounts are guaranteed. Now, of course, the higher your income, the richer you are, the more money you want. So they may have a higher whole life policy, but I'm talking to us. I'm talking to the people that are middle income, low income. This is an insurance for, this is for us to understand. People that have a lot more money look at insurance in a whole nother way. I just finished reading a book about how the wealthy use insurance to secure wealth. Okay, but right now I'm just trying to talk to you about how to get yourself covered and make sure that you put yourself and your family in a better predicament, whether you choose whole or term, universal, or whatever. All right. Next, let's talk about the surrender value. Surrender value is, remember, it's whole life and it's guaranteed. So if it's guaranteed, there's some money that can be available. The best way I can explain whole life is a savings account. If you have a savings account and you are putting money inside the savings account, that money is yours. As long as you keep checking up on that money, as long as you keep adding money to it, it's your money. Now, if you stop adding money to it, that's as much as you're going to have. But if you continue to add money to the account, you are going to have that money when you're finished. Okay. And if you decide after 30 years, for whatever reason, that you do not want that savings account anymore, you can go to the bank and say, I don't want this account. Let me take my money. No different with whole life. If you have a whole life policy for 30 years and you decide you don't want that policy anymore, you can ask for your money back. You can ask for your surrender value and take it away. Most policies have that option. Not to be confused with cash value. So some policies also have a cash value, whole life. Remember I said it's like a savings account. So savings account have interest rates. Your insurance policy has value on it that comes from the interest that you have been paying on it. Okay? So some people you may hear say they're borrowing from their account. They are borrowing from the cash value of their policy. Yes, they have to pay it back, but it's still their money that they can access. No difference from a savings account. If I have $50,000 in my savings account and I want to start a business, so I decide to take $25,000 out, I'm going to be $25,000 short in my account unless I pay it back. No different with life insurance. If you borrow, you have to pay it back. And if you don't pay it back, you won't have the entire policy. You'll have whatever you have left over. Okay. Some insurance companies, also pay dividends. So there is something called participating and then non-participating. That's similar to like stocks and stuff, but they have money available to their members. They take it yearly, sometimes quarterly. All right. I have dividends on my insurance policy on my whole life. And I take mine in cash. Some people decide to leave their dividends on their policy to make their policy grow. Okay. To make it grow, let me make it make sense. I start my policy out $25,000. Each year I'm getting cash value, but instead of taking that, not cash value, each year I'm getting dividends. Instead of taking my dividends in cash every year, I say, no, let me leave that in the bank and let it grow some interest. 20, 30 years down the line, that $25,000 is now $50,000 because it has grown interest. Because remember, you're adding more money, you're compounding more money, and there's more interest on that money. Because the interest isn't on the $25,000 anymore. Now it's on all that money that I'm adding to the $25,000 every year. All right. Hopefully I didn't say that too fast. If I did, rewind it, because that's important to catch. If you can, find an insurance company that pays dividends. It's guaranteed as long as you pay. We talked about this already. It's your money. Guaranteed. Just pay it. You can also pay it off early. So remember I said at 100 you could get a check and you'll be done. Some people actually pay it off in 20 years. That's called a 20 pay. You may want to pay extra, and in 20 years, your policy is complete. You don't have to pay another thing. There's a lot of commercials on TV that have companies. I don't want to mention it, but they have companies that your policy is paid off at age 21 if you started for your kid. That's a good policy to have. What better gift than to give your child at 21 an insurance policy that's already paid off, so they don't have to look into these things except for maybe for their kids. But at 21, wouldn't it be a nice gift if your parents offered you an insurance policy, a whole life policy at that you don't have to pay anymore? At least you can have the peace of mind that everything will be taken care of for you. All right. And the last thing, and it's probably one of the most important things about whole life, the premiums are level throughout the length of the policy. So if I start my policy today when I'm 25, my policy is going to be the exact same amount when I'm 55. Same amount when I'm 75. So it does not go up. Some people policies go up every 5 years or go up every 30 years or something like that. Not these. They stay the same. Okay, I don't have to spend too much time on Universal. Universal is another permanent insurance, very similar to whole life. However, there are a few differences. There's the flexibility in the Universal that I like. Okay, so you can kind of flex your policy value and you can flex your premium as the time goes on. Okay, that alone will probably take a whole nother video, but just know that Universal is a great policy to have. It fluctuates, it can go up, it can go down, but it'll stay within a certain particular range. Okay, just know Universal is permanent. Okay, guaranteed issue and simplified issue are those commercials that we see that say no health exams needed, no questions asked, everyone is accepted. And they are not lying. Everyone is accepted, and no health exams, no questions, nothing. They will accept you if you have HIV. They will accept you if you have cancer. They will accept you if you're on dialysis. It does not matter what health condition you have, you can be accepted. And just like they will accept anyone with cancer or those conditions that I mentioned, they will also accept someone that's healthy. They ask no health questions. However, the problem is not the problem, but the issue with this policy is that since they accept everybody, they pretty much have to give you an average of what the prices are. Let me see if that makes sense. That doesn't make sense, but let's say I'm taking healthy people and unhealthy people. But to make up for the loss that I'm going to get by accepting unhealthy people, I have to make my healthy people pay a little bit more money. So whereas a policy that may cost you $50 a month may cost you $80 a month, because I have to make up that money that I'm going to lose because of the people that are more sickly. Okay, these insurances, like I said, you see it on TV all the time. And probably my second most asked question, other than what's the best one, is, so when does insurance start? Do I have to wait 2 years? This is where that 2 years comes from. These guaranteed policies do not go into force until 2 years. So that's very important to know. If you get you have a whatever disease you may have, you have HIV, and you go get this insurance, they ask no health questions, so it doesn't matter. However, if you happen to pass within a year, you will not get your policy. Some of them will only give you your premium back. So that's a ROP, return of premium. So that's really the three important things to remember. No health exams. Everyone is accepted. You have to wait 2 years, and sometimes you can at least get your money back. Okay, quick story. We had this insurance. My dad ordered some insurance for himself. He saw it on a commercial. He was being responsible and said, oh, you know what? Let me make sure that my kids don't have to worry about, burying me. He got some insurance. However, and unfortunately, he did not make it to 2 years after that policy. So that policy was really null and void. Final expense is a permanent policy that has lower policy amounts. So when I said lower before, I was talking 25,000, but when I'm talking final expense, I'm talking more like 10,000, 5,000, 7,000. These are basically, sometimes you'll hear people say burial insurance. This money is really just here to bury someone. Okay? Other insurance, in which you may or may not know, is not just for burial. Other insurance can be used for wealth creation. It can be used to pay bills. It can be used just to help your spouse and your kids survive. It's not just for your funeral. Final expense is pretty much just enough for your funeral and maybe some small bills. Final expense obviously is going to be for older people. Older people cannot always easily find a regular whole life or a regular term without spending $200 and $300 a month. Final expense policies are a lot more affordable for a senior, especially a senior on a fixed budget. Okay, let's talk medical versus non-medical. My number three most asked question would be, do I have to take a blood test or do I have to give urine? The answer is no, unless you are getting a medical policy. Medical policies, if you pass, tend to have smaller premiums. So where someone with a non-med, kind of similar to what we were doing with the guaranteed issue, okay? Kind of similar when it comes to prices. We have to make everybody pay. Remember, it's insurance. But anyway, the non-medical people may pay a little bit more than someone with medical. Because remember, if I turn my blood in and you did a check and found out nothing is wrong with me, my policy is going to be a little bit lower. Most people that I deal with usually tend to go non-medical. It's not that much of a difference between medical and non-medical that I've noticed that will make someone decide to go give blood. And it could kind of backfire on you, because I've heard stories of people that wanted to do medical, took a medical test and found out that they had something going on in their body that they did not know about. So be very careful with medical versus non-medical, unless you know for sure that you're super healthy. Okay. Also, for those non-medical policies, what they use is a company. Well, it's something called MIB. It's the Medical Information Bureau. So they check that bureau and they will see like your prescription history. So whereas you may answer no to all of those questions, if your doctor sent you a prescription in and you fill that prescription, it is going to show up on your MIB. Some people try to do policies and medicine comes up on the MIB that they probably didn't know of. Sometimes it may get coded, and not saying they're doing anything wrong. Sometimes it may get coded. For instance, I'll use myself as an example. I used to take a medicine called Topamax. Topamax, I take it for migraines. However, some people take Topamax for seizures. They came back and asked me about the Topamax, and I had to show them and tell them that I take it for migraines and not for seizures. I had not been diagnosed with seizures, so I was not being treated for that. I was being treated for my migraines. So that leads to my next point. Be careful what medicines you take, and be careful when you go to get your insurance. I would probably go get some insurance before I go to the doctor, especially if you're expecting something. I mean, I don't know if that's legal, but I would probably go to the doctor. Go get my insurance before. Some medicines will automatically knock you out of being covered. Okay. Well, I won't say automatically. Well, I won't say knock you out of being covered, but they'll make it more difficult for you to be covered. Because just because one company won't accept you, that does not mean that a different company won't. So your medicine history is important. Okay, I think I covered about almost everything that we need to discuss. This is the basics. So this is the things that most people ask me. Follow me on Instagram at Get Covered the LLC. That's my Instagram. If you have any questions, remember to like, comment, and subscribe, share. Go get you some insurance, get covered. I work in several states. So if you have a question or if you want a quote, don't hesitate. I will be available. Thank you again for watching.